Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 25th of July, 2024. So before we start our Daily Dose of Market Insights, as usual, let's have a quick look at the disclaimer first. Okay, I believe that the screen is good. Yes. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so just to make sure that my voice and my screen is good, yeah. Okay, just do a check first. Let me check my screen. Yeah, I believe that should be good. Yeah, should be up and running. All right, so with that, now let us now very quickly share what has taken shape yesterday, which is very important after the significant movement on the FX market earlier on this Monday, where we start to see the yen strength coming into play, which I really highlighted on the daily dose at the start of this week. And now there is another significant movement on the global market yesterday as well, which was the sell-off in the US mega cap technology stocks yesterday. It potentially could have a multi-week impact on the major US stock indices as well as globally. So later we touch more about that. But before that, let us have a quick look at the key highlights and events that has taken shape yesterday in terms of the economic data releases first. All right, then thereafter we jump into the short-term intraday technical outlook, followed by again intermarket dynamics, then followed by the intraday technical outlook on the various major cross asset classes. Okay, so let us start with what has taken shape yesterday in terms of economic data releases over here. Okay, let me share my screen so that you guys could see. Okay, excellent. All right, so let's look at the calendar. Okay, so what we could see over here is yesterday we see a slew of this flash PMI releases from both the manufacturing and the services across the globe. So what we could see over here is in Eurozone, the manufacturing PMI in Eurozone still remains lackluster. That means we are talking about a rather weak manufacturing sector in Eurozone, which still in a contractory mode of 45.6, which came in below expectation of 46.1, and even the services is rather bad as well. Yes, even though they continues to remain above 50, but rather lackluster is at 51.9 versus 53 that was market is expecting. So you look at the services activity in Eurozone over here, the 12-year trend or the 1-year trend so far, since hitting the high of 53.3 in April, the growth has slowly starts to temper off instead of decelerate. So what it means that over here is economic growth in Eurozone remains lackluster, which also implies that there's a high odds that I would say that there is a high chance based on this latest release of preliminary July manufacturing and services PMI in Eurozone that continues to flash lackluster readings. In my opinion, there could be a chance that ECB may cut interest rate again before 2024 ends, despite the fact that the last week ECB press conference, as being noted by the ECB President Lagarde, she did mention that the September meeting is still white. That means they are still kind of data dependent, but based on the latest data that we see from the services PMI and the manufacturing PMI of Eurozone, is still indicating lackluster growth in Eurozone, which implies a further support of additional liquidity requirement that the Eurozone required from the ECB to kickstart growth. All right, so that should explain why the euro weakened against the dollar yesterday on an intraday basis as well. And if you go down the line over here in UK, UK not too bad. If you look at UK, the services and the manufacturing PMI managed to actually it more or less in line with expectation. So for the manufacturing PMI in UK, 51.8 for July, above 50.9 in June, and almost on par with expectation at 51.1. And for the services side of the story in UK, is the services PMI 52.4, slightly above 52.1 in June, and almost on par with expectation of 52.5. And in US, over here, the services PMI in US managed to continues to expand at a healthy rate at 56 versus 55 in the previous month of June, and also slightly above expectation of 55. So if you look at the services industry in US, based on the services preliminary PMI figure, it continues to expand rapidly, totally going against what we are seeing in UK or even in Eurozone. So what it means that the US economy is still in a healthy clip. That means, i.e., we are not any signs of a recession yet at this juncture. So despite the fact that yes, this services PMI is expanding at a faster rate, so far market participant hasn't derailed the first interest rate cut that is still expecting to come in the September meeting for FOMC. So if you look at the CMI, the CME Fed Watch 2 yesterday, the Dow hasn't really changed much despite this rather strong growth in the services industry in US, as portrayed by the preliminary flash services PMI for July. All right. So if you look at the CME Fed Watch 2, okay, give me a couple of seconds for them to load. Okay, so what we could see over here is that market is still expecting, just a slight dip, because previously which it was about 98%, right? So on the previous day, which I shared with you all, so now it dips slightly below, but it's still at 90% now. Still a high chance that they are looking for the first cut to come in at September FOMC meeting. That means 18th of September for the Fed to actually cut to 25 basis point lower, to bring the Fed funds rate to 5% to 5.25%. Then thereafter, another chance, also a high odds right now at 71% chance of another cut on the 7th of November to bring it down further to 4.75% to 5%. And very interestingly, what's the chance of another increase, or the chance has increased, pardon me, for another cut before 2024 ends to bring it down further to 4.5 to 4.75. So right now it shows a 64% chance on the 18th of December FOMC meeting. So if you look at the current pricing of what we see right now, that means first cut come in 18th of September, followed by 7th of November, then thereafter followed by 18th of December. So all in all, right, what we could see over here is that market is still expecting the Fed to kickstart a interest rate cut cycle on the 18th of September FOMC meeting. So that will be the first cut, then follow thereafter, subsequently there could be more cuts down the road. So at the moment in time, the Fed stance, as portrayed by the interest rate Fed funds futures compiled by this CME Fed Watch 2, is still indicating a dovish US Federal Reserve, rather than the US Federal Reserve looking to hike rates again. So that is what the market is being portrayed, and it's all being reflected in the US yield curve as well. We're talking about that bull steepening of the yield curve. All right. So, but however, this is the fundamentals, all right? The fundamentals. So right now we know that markets move by fundamentals, move by flows from derivative product, and as well as momentum. All right. So that these three particular movement actually causes short-term bursts in the market. Okay, long-term wise, the fundamentals are still bullish for the US stock market. All right, it's still very bullish on the US stock market. So the reason over here is that I want to stress over here is that why you start to see a very strong eruptive move or sell off in the US stock market yesterday. Okay, there's this huge sell off at this point in time. So this huge sell off over here is actually being driven by the mega cap stocks. All right, that means especially on the AI side of the story and Nvidia. Okay, at this point up. So what you see over here is that Nvidia, part of the AI team play, and do not forget most of the mega cap stocks also has starts to more or less put in a way that include AI as part of their product suite, like Google, Meta, Amazon, and even Apple as well. So Apple last 3 to 4 months back in their so-called product conference, actually starts to introduce AI into the next model of iPhone. Okay, so everybody want to have a piece of this AI story. So yes, AI has been very strong. So what I could see over here is that once any particular of them hit and it starts to spread like a disease throughout the entire mega cap sector, and because of this mega cap stocks has a significant influence in the two key major US stock indices, which is the S&P 500 and the Nasdaq 100. So yesterday, the S&P 500 actually plunges by 2%. So if you look at the movement of the S&P 500 over here yesterday, it plunges by 2.32%. And the worst hit was the Nasdaq 100, down negative 3.65%, because Nasdaq 100 itself is much more heavily weighted on the mega cap stocks. Okay, much more heavily weighted. And even the top performer in this since the start of this month, due to the bull steepening play that I highlighted earlier, those a couple of weeks back, the Dow Jones and the Russell 2000 also cannot manage to hold on to any gains, and the disease starts to spread to the outperformer, Dow Jones Industrial Average and the Russell 2000 for this month. All right, because for this month, the Dow Jones and the Russell 2000 actually outperformed the Nasdaq and the S&P 500 due to that bull steepening US Treasury yield curve. All right, so I don't talk more about that because I already highlighted in the previous daily dose. All right, so today's daily I'm going to mention about why the spread of the sell off on the S&P and the Nasdaq at this moment in time causes this negative feedback loop even into the outperformer Dow Jones and the Russell 2000, and potentially it could actually lead to the rest of the world major stock indices start showing weakness in a medium term perspective as well. So over here, what we could see is that the Dow Jones is down negative 2.5%, the Russell is down negative 2.13%. Okay, so now the key thing about this milestone is the S&P 500. All right, so let us start look at the S&P 500 first. All right, given that it's the mother of all global stock indices. Okay, let's look at the chart of the S&P 500 over here. Okay, this S&P 500. Okay, so this was yesterday's plunge. All right, down negative 2.32%. It's just gap down, and this gap down over here. Notice there's this huge gap, right? This gap, and this is not a weekend gap, because this gap down was being seen on Wednesday, and yesterday was Tuesday. All right, Tuesday is not a Friday where we have the weekend gap. So this gap down very significant. Why? Because it's caused by Google and Tesla earnings results that was released on Tuesday after the close of the US session that didn't actually meet market expectation, especially on Google. Yeah, because Google, yes, it beat, but it didn't beat as much at one of the particular business segment, which is the YouTube ads that causes the market to plunge down. Right. So, and another significant thing in terms of momentum is at the bottom of this chart over here. Okay, this one, let me expand it. Okay, so this chart over here, if you could see, maybe you guys can't see, let me change the color so that it's much more, not so bright. Yeah, this particular color. Okay, so what you could see on this screen over here is the rate of change of S&P 500 on the daily basis. So yesterday it plunges down to 2.32%. Okay, then this is the negative 2% mark. So for the entire run over here, since almost 1.5 years, that means since February, okay, since this one, okay, this one, okay, since 21st February 2023, the S&P 500 on a daily basis didn't ever have a negative, more than negative 2% plunge. Okay, sorry, I think in fact it's here, December last year, all right, December, okay, this is not December, let me please, okay, 15th of December 2022. All right, so it's roughly close to about 1 year and coming to about 2 years, about 2 years. So around 2 years, since 2 years, around, I'll say around, not exactly, around 2 years, the S&P 500 on a daily basis didn't have more than 2% plunge on a daily basis. And yesterday, it occurred for the first time since around 2 years, all right? It plunged below negative 2%. So it actually has, because of this significant movement, and in the past almost 2 years, we don't see such intraday weakness by the close on the S&P 500. It created that significant negative feedback loop into the rest of the market, and that causes the fear into even the top performing US benchmark stock indices, which is the Dow Jones and the Russell 2000, driven by the yield curve steepening, that they could not also escape the negative feedback loop that is being seen on the S&P and the Nasdaq 100. All right, so this is the movement that has taken shape yesterday on the major US stock indices. And on the FX market, what we could see over here is this: there is still the continuation of this K-shaped performance. That means, i.e., we start to see the Aussie and the Kiwi underperforming the US dollar. That means the US dollar now is the strongest against the Aussie and the Kiwi, and that also could potentially explain to us why the continuing of strength of the Aussie and the Kiwi, because of weakness in Aussie is related to the China stock market or the China economy. Let's put it away that the China economy, because Aussie, Australia do have a significant exporter of commodities, especially commodities that related to industrial commodities like iron ore and copper, especially iron ore. And given the fact that the Chinese top policy maker at this point in time, they still do not believe that they should actually engage in much more forceful stimulus measure to jumpstart economic growth in China. That means pertaining more to the property markets, as well as building infrastructure, or giving direct subsidies to consumer, like vouchers, like what the US did during the COVID-19 pandemic to boost consumer sentiment. Instead, the top policymakers are still focusing on quality and productive growth sector of the Chinese economy. That means they are focusing on in the high-tech industrialization. That means lots of their resources is being pumped into this high-tech industrialization, like getting the best semiconductor know-how to actually engage in the ongoing high-tech war with US that's playing out right now, because US and the allies kind of forbid China semiconductor firms of getting the best technology know-how to actually build a better, we call it a semiconductor processor or semiconductor related products, due to this we call it ongoing high-tech war between China and US. And also China also wants to keep on advocating EV, clean technology, which EV is one of them, and as well as the biosciences. So not so much on jump-starting the economy using what the previous playbook did. That means build infrastructure, build more properties, because all this building of infrastructure and building of properties required a lot of infrastructure investment. Like in that case, they will require iron ore, they will require copper to actually build such infrastructure. So that actually explained to us, without any strong initiative to jumpstart the Chinese economy using this measure again, like what they did 10 years ago, by building infrastructure via the property market. That means, i.e., there will be lesser Australia exports of such industrial commodities like iron ore to China. So that actually explained to us since the start of this week why the Aussie is so weak against the US dollar, or why the dollar is so strong against the Aussie. And we know that the Aussie and Kiwi track hand in hand. So that is what explained to us the direct correlation that the Kiwi has with the Australia dollar. So if the Australia dollar, if the dollar is strengthening against the Aussie, it should also strengthen in line with the Kiwi as well. And also the Australia currency in traditionally, because it's still having this kind of psychological behavior that also kind of have a direct correlation with the risk on and risk off behavior in global equities as well. And given the fact that yesterday's we do see a significant negative feedback loop that has taken shape in the US stock market, that could actually spread globally, and that explained to us why the Australia dollar weakened yesterday as well, given that the Australia dollar is being seen as a high beta currency that move in line with the global sentiment of global equities. All right, and what's interesting over here is that the rest of the other dollar against the other major currency, like the dollar CAD, the dollar euro, the dollar sterling, and even the dollar sing and the dollar Swiss franc and the dollar Chinese yuan, kind of more like a sideways movement instead, based on this 5-day rolling performance as of now when we are speaking. Okay, and what's interesting over here is that the dollar yen continues to plummet. That means the dollar continues to weaken against the Japanese yen. So we see this kind of K-shaped performance. K, very obvious, right? There's a K, right? The K at the top, the K at the bottom. Okay, the K-shaped performance. Okay, where we start to see the dollar is the weakest against the Japanese yen, and this shouldn't be a big surprise, because I already covered in my daily dose on Friday as well, and as well on the start of this week, because of that potential Japanese yen revival, at least in the short to the medium term, because of the US Treasury yield premium is getting lesser against the JGB, and also as well as from a cross asset perspective on the FX market, the yen is not even weakening against the dollar is not even weakening against the yen, or I would say, I put the way that the yen is not in fact strengthening against the dollar, but the yen also strengthening against the other major currency as well. So if you look at what do I mean by this? If you could actually, I could expand my screen on the other. Okay, so you guys could see much clearer. Okay, so what we could see over here is that, okay, let me change this. Okay, so this will be today's date, 25th of July. Okay, so let me share with you guys this one month. Okay, so this is the 1 month rolling performance of the G10 yen crosses. So I could see that since 11th of July over here, 11th July, you also move in line with this is the 2-year JGB, no, 2-year US Treasury yield minus the 2-year JGB. So what I could see over here is that the US Treasury yield premium continue to string against the JGB, all right, making yen as a carry trade unattractive, and that actually translate to the yen strengthening against the other major currency. So what you see over here, the Euro yen tumbled, the Swiss yen tumbled, the CAD yen tumbled as well, the Aussie yen, the Norwegian SEK yen tumbled, Kiwi yen tumbled, and the NOK yen also tumbled as well. So what we could see is across the board yen strengthening. So that also causes this kind of feedback loop into the Japanese yen market as well. All right, that means potentially we could see this persistence yen strength coming back into the picture on the FX market from a short to medium term perspective. All right, so later I'll share more on the intraday technical outlook. All right, so with that, okay, that sum up what has taken shape yesterday in terms of the economic data from the fundamental perspective and from a price action perspective from a cross asset performance over here. Now let us now jump straight into the intermarket dynamics I want to share with you all. Okay, so we know that over here, let me share with you this particular chart. Let me save this. Okay, let me open up this particular chart for you guys to see. Okay, let me put it over here. Okay, Okay, this is more related to the US stock market. Okay, let it load first. Okay, good. So this is the year-to-date performance. Okay, this was previously, all these numbers are 15th of July. Okay, so now the numbers has really changed. So what I want to highlight over here is that, do you notice that year-to-date, the market is before, even before yesterday's sell-off on the US stock market, AI is still the number one play, all right, that is driving the entire US stock market, and that has also a positive feedback loop into the rest of the global stock market as well. That means any particular regional stock market that is part of this AI play, like Taiwan, Japan, in some form, Korea, Singapore, there's none, because Singapore STI, there is no AI related stock component stock inside the benchmark index. Now back to this over here is that Nvidia is a top performer. Even yesterday's sell off, we see it at 133% year-to-date performance, and that also starts to drive up the mega cap stock as well. So the mega cap stock, including Netflix, I put in Netflix, is up by 21%, and SOX itself, the pure semiconductor play, is up by 21%, very similar, right? So that kind of actually surpassed the gain of the SPX and the Nasdaq 100, all right, by a fair bit, by about 5 bit. So what I could see over here is that we don't notice that at this point in time, if this AI kind of over optimism starts to see profit taking that has taken shape yesterday, spreading to the rest of the mega cap technology stocks, it could actually lead to what I call this negative feedback loop into the other major US stock indices as well, and thereafter spreading towards the rest of the globe. All right. So what do I mean by this? If you look at the current situation in Asia right now, we see a sea of red. Japan is down, Hang Seng is down, China is down, and even we start to see, we go all the way down over here is Korea is down as well. Okay, only Taiwan is currently up at this moment in time, and the rest of the other Asia stock indices is down. All right, Australia is down, Singapore is down, Thailand is down, Indonesia is down, Malaysia is down. All right, Nifty haven't opened yet. It's the India market. Okay, so net overall is a kind of a across the globe sell off that we see today. Okay, which is being significant. And also, why does it sell off over here? Is that because there is a lot of heavily weighted movement in the AI play. All right, so once there is heavily movement in the AI play, it leads to what I call a very low correlation among the top 50 SPX stocks. Low correlation. Why? Because the how is it by low correlation? Because certain component stocks in the S&P 500 is outperforming, the other is just going sideways. All right, so how do I express that, right? By looking at this particular chart here. I think this is the first time that I share with you during my daily dose, but I do share some of this in some of the premium quarterly outlook, the updates that I shared before. Okay, so I want to share about this particular orange line here is actually the CBOE 3-month implied correlation index of the S&P 500 top 50 stocks, right? So if you look at previously in the week of 8th of July, just recently only, it corresponds to the SPX hitting the all-time high as well on that particular week, all right, 8th of July. So on 8th of July over here, the 3-month implied correlation index, the one in orange, actually went to an all-time low of 7. Okay, give me a minute. Yeah, it's here. Week. All right, it went to an all-time low of 7.8, a very low level. So it implies to us that among the top 50 stocks in the SPX 500, very low implied correlation. Why? Because only some portion of them are actually outperforming. That means those guys who are in the mega cap stocks led by AI play is on the upside. But whereas the other we call it few stocks, that means the other top 20 or top 30 stocks or so whatever, is more moving kind of a sideways. Okay, and also because of this rather low correlation index, it lead to the VIX to actually be persistently compressed below the 18-year average of around 19.3. So the VIX itself on that point in time is very low. It's at 12.47, a low VIX. All right. So we know that VIX itself is a fear gauge. So there is too much complacency in the market at this juncture. So too much complacency means everybody believe a fear, no fear. That means everything is going to be very good. That means this AI stocks is going to be higher and higher and higher. AI is the next in thing that everyone wants to own. That means smooth sailing for the AI stocks. Eventually, it lead to what I call the S&P 500 to continues to churn up higher and higher. But however, take this form as a contrarian opinion indicator. If there is too much complacency going on in the market, any little movement or negative feedback loop in the market, it will create an erratic move in the VIX index. That means the VIX index can suddenly do this kind of spurt up over here. Notice that this spurt up at this point in time in February 2018. So in February 2018 over here, those who knows what happened in February 2018 was prior to that, the VIX was also very low. And suddenly there was this split up in the VIX. And this split up in the VIX causes the S&P to actually tumble over here. Okay, let me share with you the percent change. From this high, it tumbled to about 9.9%. Then thereafter, it went up again. Okay, then this is during the start of the trade war. It was net overall, there was a drawdown about 16% then. Okay, here to here. So this Warmogeddon, right, over here is caused by a very low compressed VIX as well. And suddenly there was actually everybody starts selling volatility ETF, and due to some reason, there was also a negative feedback loop that causes the VIX to actually plummet. And those who actually have a long position in this sell ETF that are related to short sale of volatility got blew up and causes that I think one day a significant plunge on the S&P 500 in early 2018. All right, so there was a significant movement on the S&P 500. So what we could seeing over here is the very similar price market behavior on the VIX index. That means the VIX is being compressed at a very low level. Why? Because everyone had a fear good factor in AI play, and as well as driving the mega cap up performance. And right now, after the earnings result of Google, everybody now has got to readjust their earnings expectation on the Google itself and even the other mega cap stocks, and could potentially start to see a erratic, what I call a significant earnings expectation adjustment on the mega cap stock going forward. But because of that 2%, more than 2% plunge on the S&P 500 yesterday, it could actually create that erratic adjustment on the fear gauge factor, which is the VIX. That means if the VIX starts to actually continue to inch up higher over here, given a very low depressed correlation, 3-month correlation index of the S&P top 50 stocks, the negative feedback loop over here may not be only one day on the S&P 500. It could be starts to lead to a persistent multi-week corrective decline. Okay, this is something I want to share with you all. And do not forget, right now, the market leader for sure over here is NVIDIA. So let's have a quick look at the technical chart of the NVIDIA as well. Okay, so what you see yesterday movement on the NVIDIA, it also plunges below the 50-day moving average. All right, so it clearly closes below the 50-day moving average. That means, i.e., right now there could be a multi-week corrective decline in NVIDIA to retest 95.10, which is the lower boundary of this major ascending channel that I drew from the low of October 2022. All right, so if we start to break down below 95.10, then NVIDIA could actually may lead to a multi-month corrective decline instead to actually retest the 200-day moving average. So we know from a short-term to a multi-week perspective, NVIDIA is much more skewing towards on the weakness side of the story rather than another potential bullish outburst for NVIDIA. And if you look at NVIDIA, where is the earnings? So the earnings over here, let me share with you. Okay, it's only on 28th of August. Okay, so it's only about a month more to go before NVIDIA releases its next earnings. All right, over here. So that means from a multi-week perspective, momentum doesn't looks quite bright for NVIDIA technical analysis that I shared with you earlier. So that could also further add on pressure to the S&P 500 and the NASDAQ 100 from a multi-week or medium week perspective that could start to see this persistent multi-week corrective decline on the major US stock indices unfolding, and it could start to spread out towards the rest of the world as well. All right, so today is a bit long on the intermarket perspective. Why? Because of this important development that has taken shape yesterday that I want to share with you guys. All right, so with that, now let us jump straight into the intermarket. Let's jump now into the intraday technical outlook, okay, on the major cross asset classes, starting from the FX market. Okay, so with that, let me expand my screen so that you guys could see. Okay, over here. Okay, let me start with the euro dollar first. All right, so now it's on an intraday basis. So euro dollar yesterday, we actually went to flip to a bearish bias, looking for a kind of a test on the 20-day moving average and with a 1.0805 level. So it hit the moving average, and interestingly, after hitting the 20-day moving average, the hourly RSI starts to shape a bullish divergence. So with this appearance of a short-term intraday bullish divergence on the hourly RSI, it indicates to us that potentially there's some form of intraday bullish momentum creeping back into the euro dollar. Okay, so with that, we'll flip to a short-term intraday bullish bias using 1.0805 as my short-term pivotal support on the euro dollar. Near-term resistance level to watch on the intraday basis will be at 1.0880, 1.0990, followed by 1.0920. Only an hourly close below 1.0805. We also confluence with the 50-day and the 200-day acting as a similar support level at 1.0805. We'll invalidate today's intraday bullish bias to see the extension of this minor corrective decline to expose the next near-term support at 1.0770, 1.0730 next. That's for the euro dollar. And also for the sterling dollar, yesterday, because of the break below the 1.29 figure level, we flipped to a bearish bias. And even it hasn't hit below the 1.2845 support level yet, which is correspond to the rising 20-day moving average. So it has still a bit more room to go before hitting this support level. So with that, no change. We still maintain a short-term intraday bearish bias using the 1.2940 as a short-term pivotal resistance that we have yesterday. So during yesterday's the start of the US session, it can't break above this pivotal resistance level, which indeed is a key level to watch in the shorter term basis. So no change, still maintain a short-term intraday bearish bias on the sterling dollar, 1.2940 short-term pivotal resistance. Support level to watch will be at 1.2845, which correspond to the rising 20-day moving average. All right, only an hourly close above 1.2940 will invalidate today's intraday bearish bias on the sterling dollar to see a potential squeeze up to retest the next near-term resistance level at 1.2990, followed by 1.3040, 1.3065 next. Okay, so that's for the sterling dollar. Moving on will be the Asia Pacific currency, starting with the Australia dollar first over here. So for the Aussie dollar, no change. Price action continues to break down below the 200-day moving average. There is no signs of a bullish divergence that's being seen on the hourly RSI, indicating to us that downside momentum still remain intact on a intraday basis as well. Okay, so this level has already been taken out. All right. So now, overall, there could be a minor bounce taking shape because it really hit the oversold level. So first resistance level to watch for this minor bounce will be that 200-day moving average also that former minor swing low of 24th of July, now acting as a first resistance at 65.80. All right, so we'll be using a Titan key short-term pivotal resistance for today at 66.10, which is also confluence with this swing high area of 24th of July. And if we do the Fibo retracement of this entire push down, okay, it corresponds to the 20% as well. Okay, 23%. So what you could see over here is a extended fifth wave move on the downside. All right. So we're talking about this 1, 2, 3, 4, 5. This extended fifth wave move on the downside over here. So the next, as long as this bounce didn't surpass 66.10, that means it didn't surpass today Titan key short-term pivotal resistance at 66.10, will still remains a short-term intraday bearish bias on the Aussie dollar. 66.10 Titan short-term pivotal resistance. Next near-term support level to watch 65.20, followed by 65.30 over here. Okay, 65, 60. Okay, follow me. A bit of tongue twisting. 65.20 followed by 64.65. All right, so which correspond to this minor swing low of 1st of May, and as well as the 76% Fibo retracement taken from the low of 19th of April all the way up to 11th of July. Over here, only an hourly close above 66.10 will invalidate today's intraday bearish bias or the Aussie dollar to see a squeeze up or a mean reversion rebound scenario unfolding to expose the next near-term resistance at 66.70, which correspond to the 50-day moving average acting as a resistance, followed by 67 figure, which corresponds to the also the 20-day moving average acting as a resistance at this level as well. Okay, so that's for the Aussie dollar. Very quickly will be the dollar yen. So the dollar yen continues to plunge down lower as expected over here. So now almost hitting the 51.70 200-day moving average, which is coming close to the lower boundary as well, and the 1.618 Fibo extension level. Okay, pretty much close. Okay, so what you could see on the dollar yen over here is that we do not have any clear signs of a bullish divergence that's being formed yet on the hourly RSI. So momentum still continues to remain weak on the dollar yen, at least on a short-term basis, but there could be at least a minor bounce taking shape first on the dollar yen, given that the Aussie dollar is the hourly RSI is at its oversold region at this point in time. So we will have a rather tight key pivotal resistance for today, which was yesterday's US session high at 154.10. So as long as this 154.10 didn't surpass, that means the bounce didn't surpass 154.10 level, we will still maintain a short-term intraday bearish bias on the dollar yen. After 151.70, it may expose the next near-term support level at 150.80/150.40, which is the 2 times extension, okay, of the Fibo extension level. And if we do on the nested one, taken from the high of here, project it up to here, okay, there's this 2 time over here at this around the 150 figure /149.50. So if you look at graphically over here, this is the congestion area. Okay, previously from 21st of May to 4th of April. Okay, so this is the next support level to watch after 151.70 has been taken out, which is the 200-day moving average. So in first step, it may expose 150.80/40. But however, if we start to see the bounce starts to actually break out with an hourly close above this Titan short-term pivotal resistance that we have for today at 154.10, then it will invalidate today's intraday bearish bias. Pardon me, it will invalidate today's intraday bearish bias on the dollar yen to kickstart a mean reversion rebound scenario on the dollar yen to expose the next near-term resistance at 155.80, which is correspond to the upper limit of this descending channel that I drew from 11th of July. All right, so that's sum up for the FX market. Now moving on will be the intraday technical outlook on the stock indices over here. All right, so stock indices, let us start with the Asia one, the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index over here is that yesterday we are looking for at least a bounce above the medium-term pivotal, we call it support level at this 17,210, 17,110, and very clearly it actually broken below this medium-term pivotal support level, which is the 200-day moving average. So we got to respect the price action. So the price action on the intraday basis is actually bearish right now rather than bullish, with a very clear breakdown of the 200-day moving average. So with that, we will flip to a back to a bearish bias on the Hong Kong 33 or the Hang Seng Index using 17,320 as my short-term pivotal resistance level. So as long as this level didn't surpass today on the intraday basis, there could be a further risk of the Hong Kong 33 to actually shape a deeper slide to expose the next near-term support level of 16,840 next on the intraday basis. So what is 16,840? Graphically, if you go back over here, okay, is this congestion area over here. Okay, so below 16,840 level actually exposes the next area. This level here. Okay, let me put it in green so that you guys could see it. Okay, which is at 16,620. Okay, next, after 16,840 has been broken down on the downside. All right, so only a bounce. So let's say, because do not forget it's now in the oversold region, so there could be a bounce coming into play first, and plus it's now holding at the 17,030 support level, which we highlighted yesterday. So this bounce, as long as this bounce didn't surpass this 17,320 short-term pivotal resistance level, the bias is more towards the bearish side of the story. But however, if the bounce starts to actually goes above 17,320, that means an hourly close above it, then today's intraday bearish bias will be invalidated to see a much more pronounced rebound scenario taking shape, or a mean reversion rebound signal taking shape to expose the next near-term resistance of 17,517. Above it sees the minor swing high of this Monday at 17,750 coming to play. We also correspond to the downward sloping 20-day moving average, acting as a resistance as well. So that sum up for the Hang Seng Index, the Hong Kong 33. And now moving on will be the Japan 225. Japan 225 yesterday returned neutral between 38,750 and 39,350. It broke down below the lower neutrality limit. So over here, what we could see now is that we got to validate a bearish bias move on the Japan 225 or the Nikkei 225. Okay, so over here, what we could see at this point in time for the Nikkei 225 at this juncture, we do have a bearish, we do see a further bearish bias on the Japan 225. So with the fact that it hit the first support level after the breakdown of the 38,750 that we highlighted yesterday, okay, which is this minor swing low area of 31st of May and 17th of July, and with the hourly RSI at the oversold region, there could be a bounce taking shape first, all right, before another potential we call it weakness materialize on the intraday basis. So we do have a very tight short-term pivotal support level for today, but short-term pivotal resistance level for today, which was yesterday neutrality, lower neutrality range, now acting as a short-term pivotal resistance at 38,750. So as long as 38,750 short-term pivotal resistance not surpassed the upside for today for the bounce, we'll have a short-term intraday bearish bias on the Japan 225 or the Nikkei 225. Below 37,980 exposes 37,105, which will correspond to the 200-day moving average, and as well as this key swing low area of 19th of April and 25th of April. Only the bounce, if the bounce starts to shape a breakout above 38,750 with an hourly close above 38,750, then today's intraday bearish bias will be invalidated to see a potential short-term recovery to expose the next near-term resistance at 39,350, and above it sees 40,050 next on the Japan 225. Okay, now moving on will be the European stock index. So the European stock index, the German 30. So the German 30 yesterday actually broke down the 20-day moving average. So initially we are looking for a bounce to take shape towards 18,680. So this bounce didn't materialize and broke below 18,400 level. So that was yesterday's short-term pivotal support. And with that, we got to respect the price movement. It seems to us that it's now moving down towards the lower limit of this expanding wedge configuration. Okay, that is still in place since 14th of June. So with that over here, 18,395 will be my short-term first resistance level to watch. So as long as it didn't clear above any bounce, because any bounce that may take shape today didn't clear above 18,520, because this 18,520, if you look at the current push down, is the golden ratio of 61.8%, and also the gap down that was formed on Wednesday. All right, this gap down on Wednesday. So as long as any bounce didn't surpass 18,520, we will flip to a short-term intraday bearish bias on the German 30 for further weakness to come into play. 18,290 followed by 18,150 support level, which is the lower limit of this expanding wedge. So if the price action break down below 18,150, then we will see a bearish breakdown below the wedge, expanding wedge support in first step to expose the near term swing low area of 19th of June to 2nd of July, I think as a support at 18,050 next. Okay, so let me put out in writing 050 next. All right, so the next thing to watch out for over here is if we start to see a break up above 18,520 level, a breakout above 18,520 level, then the German DAX will invalidate its intraday bearish bias for today to see a squeeze up to retest 18,620, followed by the minor swing high of 12th of July at 18,770 next. Okay, now that's for the German 30. Let us now move on to the US Wall Street 30. So the US Wall Street 30 or the Dow Jones Industrial Average, yes, price action plummet managed to held at the support level, the short-term pivotal support level that we have yesterday, 39,890. We also correspond to the rising 20-day moving average. So like I explained earlier in my intermarket dynamics on the weakness, the potential multi-week weakness that could cascade to the US stock market due to that very compressed VIX level, driven by the over optimism in the mega cap stocks, and yesterday's significant push down in the S&P 500 due to the sell off in the mega cap stocks. It could actually spread to further weakness on the Dow Jones Industrial Average as well, even though the Dow Jones Industrial Average is the top performer for this month. Okay, so with that, we'll have a neutrality stance. So turn neutral for today between 39,890 and 40,185. Okay, only unless we have an hourly close today, that means a breakout above 40,185, then I could be more confident to see the continuing of this outperformance of the US Wall Street 30 to take it up higher for the next near-term resistance to come in at 40,670. So that's more of an intraday bias. All right. So flipping on the neutrality stance on the US Wall Street 30 between 40,180 and 39,890 for now. Okay, now the weakest one was the Nasdaq 100 yesterday due to the sell-off in the AI and the mega cap stocks. So with that, very clearly the price action is really broken down below the 50-day moving average, which saw the yesterday short-term pivotal support at 19,520 level. So what you could see over here is that the RSI is oversold, but there's no bullish divergence yet potentially. So what we could see now is after the breakdown of 19,520, it hit the support level at 19,155. So that was the support level we saw highlighted yesterday if 19,520 breaks. So hit the first support level after 19,520. So potentially there could be a bounce taking shape over here. All right. So as long as this bounce didn't surpass 19,520 level. Okay. So what we could see over here is that if you look at yesterday's sell off, okay, 19,520 is the 50% Fibo retracement, right? So in between over here, there is nothing much level because it's just like a one straight line. The only clear congestion over here is the 50-day moving average, now acting as a resistance, and the former minor swing low of 19th of July. So as long as any bounce, the bounce didn't surpass above 19,520, which we'll be using as a short-term pivotal resistance for today on the Nasdaq 100. We will flip to a short-term intraday bearish bias on the Nasdaq 100. Next support level to watch, 18,950, the 0.764 Fibo extension. Then that followed by the one-time Fibo extension on downside, 18,650. So 18,650 also correspond to this congestion area of 30th of May and 5th of June as well, previously in the past over here. All right, only an hourly close above 19,520 then will invalidate today's intraday bearish bias on the Nasdaq 100 to potentially see a squeeze up to retest the gap resistance on this Wednesday, the Wednesday gap down at 19,780, which also correspond to the pullback of that resistance of that former medium-term ascending trend line from 19th of April, turn into a pullback resistance also at 19,780. Above 19,780, then potentially the rebound extended towards 20,000 level psychologically, and as well as the 20-day moving average acting as a resistance as well, which confluence with the minor swing high of 18th of July and 19th of July. All right, so that sum up the short-term intraday technical outlook on the major stock indices. Moving on will be the commodities market, starting with the gold. All right, so for gold over here, let me look at it. Yes, okay. Gold XAU/USD. Yesterday we do have a bullish bias. The first resistance to watch will be at 2,431 hit, and thereafter it shaped that bearish reaction. All right, so right now it has really broken below the 20-day moving average itself, and right now it's coming very close to the first support level that has really been met. The second support level is met at 2,368 level, and with the hourly RSI coming close to the oversold region as well, and it's now coming very close to the 50-day moving average that is acting as a support level. So with that, right, elements right now are rather mixed right now, I would say. So I'll use this level here, this swing low. Okay, this swing low area of 4th of July and 9th of July. Okay, this is 2,353. 353. Okay. And this is the current, this is the 20-day moving average. I think that's a resistance level. Okay, let me immediately push it up. Oops, 2003 one. Okay, let me do it, put it nicely first. 2,386. 386. Okay. Okay, so with that mixed element, right? Since yesterday it really hit the first resistance level, then thereafter it sell off. So after, okay, let me 2,431. Okay, so hit the first resistance, then sold off, break down the low of this Monday and close below the 20-day moving average, but it's now coming very close to the 50-day moving average that's acting as support, which is the minor swing low of 4th of June and 9th of June at 2,353. So with that, elements are mixed right now. So I will have a neutrality stance for today between 2,386 and 2,353. So only an hourly close, that means a reintegration back above the 20-day moving average, then we could potentially start to see bullish momentum, at least on the intraday basis, coming back into gold XAU/USD to revisit 2,3431. So above 2,3431 may see the next near-term resistance coming in at 2,452 on the intraday basis. But however, if we start to see a breakdown below 2,353, that means a breakdown below the 50-day moving average, then this minor corrective decline could potentially extend to expose the next near-term support level at 2,337. Then after 2,337 may seek a lower low at this congestion here, which is at 2,320 next. Okay, let me put it in writing, 2,320. All right, so that's for the short-term intraday technical outlook for gold XAU/USD, neutral between 2,386 and 2,353 for today. Lastly will be West Texas crude oil. So West Texas crude oil, yesterday we do have a bearish bias because price action flip down below the 200-day moving average. So we have a pivotal support right exactly at the 200-day moving average at 78.95. Yesterday, the bounce took shape, can't surpass above 78.95 before inching down lower. So no change. So for sure, this 78.95 is indeed a short-term pivotal resistance to maintain our intraday bearish bias on West Texas oil. First near-term support level to watch will be the minor swing low of this Tuesday at 77.60. A breakdown below it exposes 76.30, followed by 75.46. Only an hourly close above 78.35. That means a breakout of the hourly close above 78.95 on West Texas oil will invalidate today's intraday bearish bias to actually see a squeeze up towards the next near-term resistance at 80.30 and potentially even 81.20 next. Okay, that sum up the short-term intraday outlook on the cross asset classes. Now, before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? All right, so for today will be Thursday. So on Thursday itself, over here, we do have a slew of German sentiment, business and current condition sentiment. They call it the sentiment data or economic data in German to be released. They call it the IFO business climate and the IFO current condition. So it's more skewed towards the corporate side sentiment, business sentiment data. So we'll be out at 4 p.m. Singapore time in the month of July. And thereafter, over here in US, we do have the first reading of the Q2 GDP growth rate. Okay, so Q2 GDP growth rate will be this will be the first reading out at 8:30 p.m. Singapore time. So US Q2 first reading of the GDP growth rate. Market is expecting an increase to 2% from the previous Q1 reading of 1.4%. All right. So with that will be a pretty quiet session thereafter. All right. So that actually sum up today's key economic data releases that I want to share with you all. So, but in fact, on early Friday tomorrow, before that, we do have the Tokyo CPI data that will be out on 7:30 a.m. Singapore time. So that could potentially drive the movement of the we call it yen as well. If we start to see a further uptick in the Tokyo CPI data, they're going to be released at 7:30 a.m. Singapore time tomorrow. That means early Friday before the start of our daily dose. All right. So with that, that's wrap up today's daily dose of market insights. It's a bit long. Why? Because I need to share with you all an important movement that has taken shape in the US major stock indices overnight. All right, that could have a potential impact to the rest of the world from a multi-week perspective. Okay, so with that, have a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.